All right, welcome. Today we're doing something a little different. We're not just talking about the self-employment tax. Oh no, we are performing a full-on forensic deconstruction of it. For so many entrepreneurs, this tax isn't just some line item on a form. It's a real financial shock, almost a trauma. And today we're going to get to the bottom of exactly why that is.
Okay, so here's our game plan for today. First, we'll tackle that feeling of the 15.3% shadow partner. Then we'll dig into the two pillars of the law itself, that's Section 1401. After that, we'll look at the Parity Engine, Section 1402, and figure out what income is actually on the table. We'll even dive into a major court battle over limited partners, and finally, we'll wrap it all up with your own forensic toolkit. Let's get into it.
All right, Section 1, the 15.3% shadow partner. Look, before we get into the nitty-gritty of the code, we have to talk about the feeling of this tax. Because unlike your regular income tax, which kind of eases you in, this thing hits like a ton of bricks. It attaches to the very first dollar you make.
And this quote, this just nails it, doesn't it? It is, in functional terms, a 15.3% shadow equity partner that demands a priority distribution of gross cash flow. That's exactly what it feels like. It's like you suddenly have this new business partner you never agreed to, and they get their cut right off the top. Before you pay yourself, before you reinvest in the business, their hand is out. It's a flat tax, and man, you feel it immediately.
So here it is, the number, 15.3%. This is the number that causes so much heartburn. But where does it actually come from? Because, it's not just one tax. It's actually a composite rate, a combination of things. And to really get it, we have to pull up the actual law, the statute that brings it into existence. Okay, Section 2. Let's get into the statutory architecture here. We're heading straight into the Internal Revenue Code, specifically Section 1401. Now, you can think of this as the mirror image of the FICA tax that employees pay. But, and this is the whole ballgame, when you're self-employed, you're on the hook for both sides of that tax, the employee's share and the employer's share. So the first big piece of this puzzle is what the code calls old age, survivors, and disability insurance, or OASDI. We all just call it Social Security. Now, under IRC Section 1401A, this imposes a hefty 12.4% tax. This is what funds retirement, disability, all that stuff. But here's the key thing to remember. It has a cap. There's an annual income limit, and once your earnings hit that ceiling for the year, you stop paying this 12.4% portion.
And then you've got the second pillar, hospital insurance, or HI. This is Medicare. Now, under Section 1401B, this is a 2.9% tax. But unlike Social Security, this one has no upper limit. There is no ceiling. This 2.9% applies to every single dollar of your net self-employment earnings, whether you make $1,000 or $100 million.
Okay, so let's put it all together. You take that 12.4% for Social Security from Section 1401A, you add the 2.9% for Medicare from 1401B, and bam, there's your 15.3%. That's the math. But wait, there's more, because for those of you with higher incomes, the story doesn't quite end there.
And that brings us to this little twist, the additional Medicare tax. Yep, this was added as part of the Affordable Care Act, and it tacks on another 0.9%. Now, this isn't for everyone. It only kicks in once your income crosses certain specific thresholds, which are laid out right there in IRC Section 1401B, too. So, here are the thresholds. $250K for married filing jointly, $125K if you're married filing separately, and $200K for pretty much everyone else. But here is the killer detail. The thing you have to notice, these numbers are not indexed for inflation. What does that mean? It means every single year, as incomes naturally rise, more and more people get pulled over these lines. It's a classic case of bracket creep, and it means this 0.9% tax is going to hit a wider audience over time. So when you put all of this together, you get this really weird U-shaped curve for your marginal rate. Let's walk through it. In Zone 1, when you're below the Social Security cap, you're paying that full 15.3%. Then you hit the cap and you enter Zone 2. Your rate actually drops all the way down to just 2.9% because you're only paying the Medicare part. But then, as your income keeps rising, you hit Zone 3, those additional Medicare tax thresholds, and your rate pops right back up to 3.8. It's kind of counterintuitive, right?
Okay, Section 3. We've got the rate nailed down, but how is it actually applied? You might think you just take your net profit and multiply by 15.3%, but nope, it's not that simple. The code, in Section 1402 this time, has this whole mechanism built in that's designed to create parity, basically fairness, between you, the self-employed person, and a regular W-2 employee.
And this leads to one of the biggest questions people have when they look at their tax forms. Why on earth do I have to multiply my profit by 92.35% before I even start calculating the tax? It seems so random, right? Well, it's not. This is the first gear in that Parity Engine, and it's all about trying to simulate that classic employer-employee setup. Let's break this down side by side, because this makes it super clear. On the left, you've got a regular employee. They pay 7.65% in FICA tax. Their employer pays another 7.65%. Now, that money the employer pays is a business expense for them. It's not considered income to the employee. So to make it fair for the self-employed person who's paying the full 15.3%, the IRS lets you pretend you're your own employee. You get to reduce your taxable base by that employer half, the 7.65%. And what's 100% minus 7.65%? Boom, 92.35%.
Now here's a fun little tax nerd detail for you. A Reddit user, BlakeH95, pointed this out, and they're absolutely right. They said, "You are correct that it is a math boo-boo from some analyst who wrote the tax code years ago." And it's true. Using 92.35% is a simplification. The mathematically pure way to do it would be to divide your profit by 1.0765. The way the code is written is technically a small error, but it's an error that actually works out slightly in your favor, so we'll take it.
Okay, so that 92.35% was the first part of the Parity Engine. Here's the second part. It's the deduction you find in IRC Section 164F. After you've gone through all the calculations and figured out your total SE tax bill, you then get to deduct 1/2 of that amount on your Form 1040. This is the other side of the coin. It perfectly mirrors an employer getting to deduct their half of FICA as a business expense, and it directly lowers your adjusted gross income, your AGI.
All right, Section 4. We've talked about the rates, we've talked about the fairness adjustments, but maybe the biggest question of all is, what income are we even talking about? What actually goes into the pot to be taxed in the first place? This is where understanding the definition of net earnings from self-employment under IRC Section 1402 becomes absolutely critical. So if you look at Section 142A, you'll see the law is very careful to carve certain things out. The whole point here is to tax you on money you actively earn from a trade or business, not on your passive investments. So things like rent you get from real estate, dividends from stocks, interest, those are generally excluded. Same goes for capital gains. Now, the big caveat is if you're a dealer in those things, but for most people, this income is safe from SE tax. Oh, and there's a de minimis rule too. If you make less than $400 for the whole year, you're off the hook completely.
Okay, Section 5. Now, you might think these definitions are all neat and tidy, written down in the code, end of story. Well, you'd be wrong. These definitions are constantly being fought over in court. And the biggest, most recent battleground has been all about one little phrase: limited partner.
The entire multi-million-dollar fight came down to this one question. You see, IRC Section 1402A13 gives an SE tax exemption to limited partners. But what does that mean? Does it mean you have to be a passive, silent investor who doesn't do any work? Or does it just mean your legal paperwork says you're a limited partner with limited liability? For a firm called Sirius Solutions, the answer to that question was a very, very big deal.
So look at this timeline. It's a real legal drama. The law itself was written way back in 1977. For decades, it was kind of a gray area. Then, in 2023, in a case called Sorabon Capital, the tax court sided with the IRS. They said, nope, it's a functional test. You've got to be passive. It looked like that was the end of it. But then, just last year, in January 2024, the Fifth Circuit Court of Appeals heard the Sirius Solutions case and completely overturned the tax court. They said the plain language of the law refers to your legal status, period. It was a massive win for tons of partners in LLPs and LPs.
All right, Section 6. We have completely deconstructed this tax. We've taken the engine apart and looked at every single gear. So now let's put it all back together into your forensic toolkit, the key things you need to remember. So here are the 4 big takeaways from our deep dive. Number 1, that 15.3% isn't one tax, it's 2. The 12.4% for Social Security and the 2.9% for Medicare. Number 2, that weird 92.35% multiplier and the 1/2 SE tax deduction aren't random, they are the parity adjustments trying to make things fair. Number 3, the base is everything. Not all your income is subject to this tax, thanks to the exclusions in IRC 1402.
And finally, number 4, remember this is a moving target. The rules are being shaped by court cases like Sirius Solutions right now.
Which leaves us with one final big question to chew on. The Sirius Solutions case was huge, right? It clarified what a limited partner is. But as the way we work continues to change, with the gig economy, with new kinds of business structures, what's going to be the next big fight? What part of the tax code will be the next battleground for defining what self-employment income even is? Because you can bet that fight is far from over.